Okay, hi everybody, and good morning. I want to start right on time because I know Andrea's a busy lady, and I know she's also an enrolled agent. So she's our fantastic local tax expert who knows a lot about, of course, tax, but also tax as it relates to real estate in particular. And she can tell us a little bit more about herself. But today she's going to talk about tax management for business owners, realtors in particular, and maybe a few other real estate and tax related topics. I'm Annie Tyler from Fidelity Title, and I have my expert escrow officers joining me on the call, Diane Patrick and Lori Fredericks. So it's a triple treat for all of you. Um, go ahead, Andrea, and let us jump in. I know we're going to go up till 11. So it's going to be action-packed half hour.
Thank you, Annie, for bringing everybody together and coordinating this with you guys' office. I don't mind a little bit of a collaborative conversation. So if you do have questions as I'm going, drop them in the chat. I think I'll see them pop up, but just unmute yourself and chime in, because if you have a question, someone else is going to have a very similar question. You should all be able to see my slides at this point. Nothing earth-shattering here. So I will introduce myself for some of you who haven't met with me before or heard me speak. I am local and I have been around real estate since before my career started, because while I was still at Santa Clara University, I started working at the board at SCORE for the controller. So I've been around real estate since before I entered public accounting. Some of the local firms that I've worked at and some of the organizations that I'm involved with. And then when I had my son, I took my small book of business and I went out on my own and started my own practice. And so these are some passions of mine. My son is in second grade, because you all need to know this. And my fur baby is going to be 11. We're in November now. So she's going to be 11 this year. So she's technically senior citizen, but I tell her she's middle-aged. And one of my favorite jobs, you can see my very official clipboard, is I'm involved as team mom with my son's Little League, which is beautiful to be able to do that during the spring tax filing season. I start all of my presentations with a calendar, and the IRS made things extra special this year. I don't know if you all follow tax news as closely as I do. But because we all, and I shouldn't say this with so much sarcasm, because we all survived the severe winter storms last winter, the IRS had granted everybody an additional time to file and pay. So we are at now the beginning of November. We should have already completed our 2022 tax returns. If you haven't already, because of the severe winter storm relief, that's a one-time only. You're not technically late. But in these next 2 months, I have some suggestions for best practices on what you can be doing to get yourself ready for the next filing season. And then these have traditional due dates. And so coming up in January, your fourth quarter estimate for 2023 will be due. Not mentioned in January. If you need to issue any 1099s to any vendors, any contractors, ask them, talk to them about it. But those are due January 31st. Then you've got a couple of months to coordinate with your accountant, get your return and income statement ready for April 15th. April 15th, we've got our 2023 returns due or extension due. You have to pay your 2023 balance with extension if you extend. Your first quarter estimates for the following year are due. And let's not forget what's also due right now and April are property taxes. So property tax installment 1 is due any day now. Property tax installment number 2 is due in April. So there's a lot of cash that has the potential to go out in April. And then we've got June 15th for second quarter estimate and September 15th for third quarter estimate. I'm going to keep these due dates because these are traditional due dates, even though I'm going to explain as best I can the storm relief. I advised all my clients just file, get everything paid in on time. But because my biggest fear was that someone was going to call me any day now and go, hey, you told me that I had to do something, right? But what was I supposed to do? And that thing that you're supposed to do is send in your estimates. I'll talk more about estimates shortly, and as to why they're so important. And I'm not sure how many folks in here have kind of been through a few filing seasons of being self-employed, or if there's any new agents. So if you have any questions, like I said, jump in. I put this slide together not because this is literally relevant, but I caution folks about sidewalk advice or news headlines. So let's say you hear your friend saying, Uncle Jim said that he had a transaction and he didn't pay any tax. Well, you have no idea what Uncle Jim's circumstances were, if he even understood his own return from his own accountant. So I always tell everybody, when you hear someone saying, oh, but so-and-so did this or that, don't just take it with a grain of salt and talk to your own accountant about what is going to happen for you personally. And headlines, they're meant to be splashy and attention grabbing. There are going to be more and more tax headlines in the news over the next probably 14 months, because Congress does have some work to do on some tax provisions that are scheduled to sunset. But until they go all the way through Congress and are signed into law, we have to operate, of course, under what is current law. So I don't want anyone to make a decision based on a headline that they heard that maybe there's a bill that really is a proposed bill that's being submitted for review and some bipartisan negotiation. But keep in mind, it's not law until it's signed into law. So enough of this slide here. This may not sound like tax advice, but we have to buy our own health insurance because we're self-employed. So the premiums that we pay are deductible. What I want to talk about here, and I'll just talk briefly about this, is a health savings account. So we just started open enrollment yesterday. Today's the 2nd, right? We just started open enrollment November 1st. That means that you should be going in and either renewing your existing coverage or buying a new policy. I encourage everyone to do some research about a health savings account, because there's 3 tax benefits of using an HSA. You get tax deductible contributions, and it's a savings account. So it's our money, it's our asset. We can invest it just like our retirement account, and those earnings grow tax-free. And we get tax-free distributions as we take money out to reimburse ourselves for medical expenses. And the list is kind of broad. It includes some over-the-counter medication, some other type of medical services. So Medicare specifically does not work that well with an HSA, if at all. You'd have to talk to a health insurance broker, but there's no age limit per se, but it doesn't work that well with Medicare. Let me clarify that. The active participation doesn't work with Medicare. Once you have an HSA account funded and you have assets in the account, it's still your asset, and you can distribute funds from it as you need. And you can continue to invest it, and it has features of a retirement account. So you can turn it into a retirement account in addition to reimbursing yourself for medical expenses. Chloe, if you have a question, go ahead and unmute yourself.
Yeah, sorry. Where do we find HSAs? I don't think they are just at a bank.
No, well, certain banks administer them. And let me caveat this with, if you're in the Kaiser plan, Kaiser is kind of an animal all to itself. So HSAs take a little bit more work when you have Kaiser, but you have to have a health insurance plan with a high deductible. HDHP stands for high deductible health plan. And HSA Bank, that is a bank that administers these. Optum Bank, Fidelity Services, health savings accounts. So they're not every bank, but there are many banks that offer these accounts. So start with a health insurance broker first, and then that will get you in the right path. And I'm going to move on from this because I want to get more into kind of the nitty-gritty of our own tax planning and organization being self-employed. So some best practices that should be year round. You don't have to wait until the end of the year or the beginning of the year comes around to do this. With the interest rates raising and increasing right now, we should all be taking advantage of a high yield savings account for ourselves. And everybody should have savings because you should be setting aside money for your estimates. Where am I here? So all of us should have some money sitting somewhere earmarked for estimating taxes, for retirement funding. You should be earning close to about 5% on your savings right now. This probably is not going to be at your brick and mortar, your Wells, your Chase. They may be only offering 0.5% right now. So you will have to go elsewhere, open a new high yield savings account. But I've been talking to everybody about this. Don't leave this, on the table and don't miss out on this. We should all have separate accounts for our business. We should not be commingling all of our personal expenses and our business expenses in one account. Administratively, it's a nightmare. Then there's a little bit more practicality to it, that being self-employed, and this is not tax advice, but being self-employed, you all know that we are a lot more difficult as borrowers to get through underwriting. They want separate books and records. So there's a lot of reasons to maintain separate business accounts, business checking, business savings. And if you want to use a credit card, keep one credit card, just business transactions. Ongoing throughout the year, make sure that you know how much money you're making. And what I mean is keep your P&L, keep your income statement current. Whether you're going to use an online system like QuickBooks that takes a lot of the work for you because it has a bank feed, it pulls it in, it becomes automated. If you have a system that's a little bit more manual and it works for you, great. I always caution people that Excel doesn't fill itself out. So hold yourself accountable, set a date on your calendar, whether it's weekly, monthly, maybe too much of a burden because that's a lot of transactions to go through. So while I don't work for QuickBooks, it's a product that's been around a long time and it works. You may have to learn how to get it to work. I certainly have bookkeepers that I work with that help train people, but make sure that you have a system because you should always know how much money you've made. You should always be able to look at your expenses and determine, is that subscription or is that cost or is that marketing effort worthwhile? Is it generating business? Or I see all too often people will subscribe to similar or the same services and they're paying for something redundantly that maybe they've even abandoned. Maybe you aren't looking to use, I don't know, Zillow, for instance, as a platform to market yourself because you found better marketing tools elsewhere, but you're still paying for it. Or, and this isn't business related, but within one household, I've seen 3 different people paying for a Netflix subscription in one house. So make sure you go through your regular recurring expenses on a regular basis. Something else to keep going and keep track of ongoing is our mileage. And this adds up quickly. So there's apps that you can put on your phone that run in the background. And I was just chatting with some folks yesterday that there are rules that you can set in the app to save yourself more time. For example, I have my parents' address as a personal trip. I have my local grocery store, my son's school as personal trips. So the places that I'm going regularly that are personal, I don't have to spend time to weed through that detail and identify that as non-business. Then everything else that falls out, probably business related. I have on here to put money into, I use SEP IRA to mean our retirement account. So that is a self-employed IRA. I'm also used interchangeably. It could be a solo 401k, but I'm just going to use that to talk about retirement. Put money in periodically. So hopefully all of you have a retirement account in place. And a lot of times what happens is you get your return done. Your accountant says, okay, your tax return is done. Here's your total Schedule C, which means I now have determined the amount that you can put into your retirement. You don't have to wait for your accountant to give you that number. You can put money in periodically. It spreads out your cash flow. And I'll chat a little bit more about retirement shortly. Estimates, I'm going to talk about next. They're very important not to get behind on. And these last two items make me a little bit excited because I'm a nerdy accountant. The IRS finally came into the 21st century with an online account access for ourselves. So as our own individual, we can set an account online. We can view our payment history, really important because we've got to keep track of our estimated payments. You can view a wage and income transcript if you've lost a document. If there's any notices that have been issued, you have access to them online. So both IRS and California Franchise Tax Board have online taxpayer accounts, and they've also made it really easy to take our money online, so you don't have to print vouchers anymore. So estimates. I have a lot of people ask me, do I have to? I don't want to. I'd rather hold on to the money and reinvest in my business because I need it to, keep my operating costs going. That's a choice, but I will refer people back to the tax code where it's not an option. We don't get to choose. I mean, we can, and there's a financial consequence to not making estimates, but we are required to make estimated taxes because we are our own employer. So let's, for a moment, pretend that we are receiving a W-2 from an employer. Our W-2, that employer takes our payroll taxes and sends them in on this payment schedule. We are our own employer, therefore we are subject to the same payment schedule. The consequence or the cost of not making estimates is they're charging you interest. It's called an underpayment penalty. And taxes are expensive enough. I don't want to see my clients pay more than they have to. And these are variable interest rates. So we're all experiencing higher interest rates right now. Well, the IRS and the Franchise Tax Board are keeping up with those increasing rates. So while this used to be 3%, they've now increased these to 5 and 7%. They're calculated daily. So every day that you go past the quarterly estimated due date, they're charging interest. So depending on the materiality of how much tax you owe, how much income you had, this can be hundreds of dollars. And if you do that consistently over a few years, it adds up quickly, and it's money that you could have spent somewhere else or invested or put into your retirement account for a deduction. And a common misconception about estimates is, and when I have new clients, I kind of have to go through this exercise to kind of train people, if you will. A lot of times people will tell me that, I will come back to this question, Anne-Marie, just one moment. A lot of times people will give me their income statement and say, okay, this is how much I closed in Q2. And that is important to know, but our estimates need to look at the whole year. So that's why having an annual budget and an annual business plan at the beginning of the year is important, so that you can project how much you're going to make through the rest of the year. So I will use third quarter as an example because third quarter is now past. By Q3, we should be paid in 75% of our annual liability for the whole year. So not just on what we earned or the profit that we had for third quarter. Sorry for my security system in the background. So estimates are cumulative. It's not narrow on just the quarter that closed. We need to look at the entire year. California we have a very special schedule in California because about 15 years ago, we were in a budget crisis. So similarly with California, it's a cumulative effect. And if you've ever wondered why your accountant gives you a payment schedule with 0 for third quarter, it's not a typo. We didn't make a mistake. Let me just close the door real quick so that I can not be as distracted.
Okay, no problem.
Thanks, everybody. All right, so I saw a question about due dates. Let me go back to the schedule. So second and third quarter are due before the quarters are over. Okay. Sometimes we can't apply logic to the government. And so this due date schedule is what it is. It doesn't fit an exact calendar quarter. Put these in your calendar. you just can't really, like I said, you can't apply logic to the government's due dates sometimes. So those are the due dates. Commit them to memory. They are, oh, and actually, let me also add this. Let's say things get busy, life gets busy, you're in the middle of a closing and you're not going to get a commission check until June 20th. And that's what you're going to use to pay your estimates. Pay them on June 20th in that example. A few days late is better than not paying them at all. So I say this a little bit sarcastically, they'll accept our money gladly any day of the year. So if you miss a due date, there's no estimated handcuff police. Send it in as soon as you can. Let me move on. Any more questions about estimates? And by the way, this, if people ask what's one of the biggest mistakes that people make, starting off being self-employed, it's not making estimates, because what happens is you get behind, you owe your entire tax liability in April. Maybe April's been a slow quarter and you don't have funds available. So send it in as you go, make the payments as you go, and it's required. It's not an option. All right. You can take notes on this. I'll talk through this at a high level. Nothing too, I think I've covered most of this already. Mileage adds up quickly. So a lot of times people will say, you know what, just use the mileage I drove last year. Well, one, that's not accurate. Two, what if you had more buyers this year than last year? What if you've been in the car previewing properties or going to more inspections this year than last year? You could be leaving an expense on the table if you don't keep track of your mileage accurately. Anne Marie, yes, if you are paid in more than your prior year liability, you may not be subject to underpayment penalties, but you still may have a balance due. So some of these questions are probably best connected with your accountant to make sure that your estimates are being tracked appropriately. So with mileage, they increase this standard business mileage rate every year with inflation. Last year, we saw a big jump because the gas prices increased so much and so dramatically. So like I said, this adds up fast and you're entitled to it. You're driving, track it in actual. Our retirement. This is our biggest deduction. I'm going to talk more about this. I know I sound like a broken record, but this should be part of your budget. This should be part of your business operating expense. So actually, I have another slide for retirement, so I'll keep going. As we keep a separate bank accounts, we keep a separate credit card. If we are incurring any interest or finance charges on business related balances, those are deductible. And that's something that may not be as easy to find. It may not be something that QuickBooks pulls in automatically, or you pay the statement, but you're not looking at that line item. So if you carry a balance, go through and pull your interest or finance charges, because that is a deductible business expense. Yes, so about mileage and vehicles. In the year that you purchase a vehicle that exceeds 6,000 pounds for the gross vehicle weight, you can fully write off the cost of the vehicle and then still track your mileage. So you always want to keep track of mileage.
I'm sorry, can I say that one more time, please, Andrea? About
so you're always tracking mileage, regardless of purchasing a new vehicle or not. With a new vehicle, you capitalize it and depreciate it. If you're buying a vehicle that's more than 6,000 pounds, you can fully, there's caveats to that too. But if you're buying a vehicle that's more than 6,000 pounds, you can get accelerated or bonus depreciation. What I say about, people ask me a lot about vehicles is, should I buy this or should I buy that? It has to make sense in your business, because at the end of the day, you have to make the payment, or you are out the money to purchase it. So if it doesn't make sense in your budget, or if it doesn't make sense in the needs, if you're not driving families of 5 around to look at properties, if you're not hauling open house signs in the back, maybe you don't need a 6,000 pound vehicle, because you've got to pay to insure it, put gas in it, charge it, whatever the circumstances are. But yes, there are bonus depreciation for large 6,000 pound vehicles, and still track your mileage. With meals, we're all because we're self-employed, and I say this personally, our business falls over into our personal life a lot of times, right? You're meeting with someone and they always want to know what their neighborhood sales are like, what their comps might look like, maybe what the rates are looking like. So as you're out spending money on meals, and I'm not saying go out to a restaurant just for a write-off, but a lot of times if you're out and you're spending money with the intention of promoting yourself, marketing yourself, connecting with your peers, that's probably a business meal. So document that on the receipt and include that in your expenses. I've chatted about this a few times. Don't estimate your expenses, because one, you could be leaving a deduction on the table that you're actually entitled to take. Two, if you're ever randomly selected for audit, not because you had a big audit risk, but nationally, 1.5% of us are randomly selected for audit from their system. And they say, hey, we want to audit Schedule C, line 24. And you gather all your expenses and you claimed more than you should have, you're going to have an adjustment with penalties and interest. So it's always in your best, the word escapes me. I'll always do it right the first time with actual expenses. And this is where having QuickBooks or a really consistent method of accounting, keeping track of your business ongoing. Home office, I'm not going to chat too much about home office, but what I will say, going back to the IRS regs, is it has to be exclusively and regularly used. So it can't moonlight as dining room table and then you move your laptop and you sit down for dinner. It needs to have a dedicated space. And from there, you apply a percentage of the square footage of your home to your homeowner's insurance, your mortgage interest, your property taxes, if you have an HOA, if you have cleaning come in, if you have security monitoring, if you have landscaping, anything that maintains and sustains your home office. Having a home office does not mean that there's an audit red flag. And then if you're ever, like I said, randomly selected for audit, as long as you're doing things the right way and keeping track and documenting, there's nothing to worry about. Let me check the chat because I see a couple of questions. Okay, meals are, yes, 50% deductible. COVID was an exception as part of a economic stimulus. They made an exception during 2 of the COVID years. That's done. So the reason that it's 50% is the IRS says you were going to eat anyway. So this is where the IRS actually applies a little bit of common sense, is they say, all right, you were going to eat a meal anyway. So half of that we're not going to allow, because whether you were entertaining a client or networking, you still were going to have lunch or dinner. So business meals are always subject to a 50% limit. That's just the way it goes. Let's see, was there another question that I missed? Is this tax benefit going away? I'm not sure if you were referring to vehicles or meals, but meals is restored to the traditional 50% limit. And let's see. No, 2023 meals are 100, in 2023, meals are 50% deductible. So the COVID benefit on that is over. That's expired. Let me move on and talk about, I think I'm talking about retirement next. I am. Okay. So hopefully you all have this built into your budget and built into your operating expenses. And what I mean by that is, as you look at your financials, you know how much your fixed and operating, your fixed costs are, your dues, you have staging for your listings, you have materials, marketing materials, there's things that you know you have to spend money on. Make retirement, make yourself one of those. So that way you don't get to kind of wiggle out of it. And I'll give you some examples. I have a lot of clients that close the year and look at how much money they've saved and go, okay, I can afford to put 20,000 into retirement. That's not planning and being proactive. That's being reactive. Make retirement part of your budget so that you know you're paying yourself. And I will say, and I say this kind of flippantly, but you're not going to regret putting money into retirement, right? And I say this even for myself. There's some years where I go, oh, I really wanted to buy a new sofa for my living room, but okay, I always end up taking my own advice. Put the money into retirement. The beauty of being self-employed is we're gonna, hopefully, and knock on wood here too, we're gonna keep closing. We're going to keep staying in business and helping our clients. So retirement is our biggest deduction, and it's discretionary, meaning we don't have to, no one's forcing us to, but we're deducting money that we're paying our future selves. So here's some of the limits. These are upper limits. So the calculation is typically 20% of our net business income. And like I said, there's some nuanced differences between a solo 401k and a SEP IRA, but they get to the same place. So I'm going to kind of talk about them interchangeably. This is 2.5 times more than what a wage earner can put in. So if we were receiving a W-2, we can put in up to $22,500 into our 401k. That's it. Being self-employed, and I say, think about who writes the tax law. People in Congress are writing law that benefit themselves, because most of the time, those folks are consulting, they work for different funds, they may be published authors, whatever their other sources of income are, it benefits self-employed folks to shelter a lot more money into retirement. So take advantage of this while you can. This is something to build into your budget. So having your financials current all the time, you can always kind of eyeball and go, okay, here's where I'm at. I've netted 100,000 for easy conversation. So I should be able to put in 20,000 into my retirement for this year. This is what informs you on how much you can budget for your retirement. It's deductible. You get tax deferred growth. So let's say you kept the same savings in a personal brokerage. So you like to invest in the stock market, which is a great place to invest in addition to real estate. And in a personal account, we pay tax every year on the dividends. If we make a sale and incur capital gains, we pay tax. So let's use 35% as an example. Every year we lose 35% to tax. In a retirement account, once we move assets into a retirement account, we don't pay tax on the gains and the dividends until we start drawing up from it, which means we don't lose 35% every year. It's all deferred. And so it has more earnings power to grow. So that's where you have the real big value of compounding assets in a retirement account. Saving personally is also advisable. But retirement assets, like I said, you'll never regret it. Let's see, let me check the question. So vehicles, vehicle section 129 has income limits. Bonus depreciation section 168K is bonus depreciation. Vehicles, there's still another question about vehicles I'm answering. Vehicle depreciation is subject to our business use percentage, which is why tracking mileage is so important. If we're driving 20,000 miles a year, the IRS knows it's unlikely that all 20,000 miles of those were business related. You're probably going to the grocery store, you're probably dropping kids off, you're probably visiting family. So there's a business use percentage that's applied to vehicles. Fleet vehicles, big company trucks, those can be 100% business use. And even if you have a personal vehicle, then you should be tracking the mileage very closely and very accurately. But remember, it's very difficult to keep non-business mileage off of a vehicle. So just track mileage really, really closely. If there's travel that's necessary in the course of your business. So what do I mean by that? If there's a conference that you attend out of the area, if you have a client that's looking at an investment out of the area, those are business related travel expenses. I have plenty of scenarios where a client will say, hey, I'm attending a conference out of town and we're going to turn it into a family vacation. It's not appropriate to write off families, travel, airfare, and meals. So you keep track of your own. But like I said, if there's a business purpose to your travel, then you include it as a business deduction.
Are you doing okay on time, Andrea? I know it's a few minutes after 11.
Yeah, I'm coming to the end, and then help me keep track at 11:15, Annie. I should be wrapping up.
Okay, got it.
But I'm going to get to Q&A here pretty soon. And then let's see, another chat question. I think the best way I can answer this is track your business mileage, have something in the background and keep track of it so that you have your personal and your business mileage that you can parse out. I'm going to move on to, so I'm going to leave kind of the topic of how you all plan for your taxes as being self-employed, and briefly explain an offering that I have that can help your clients. If you have clients that are sellers that you think are in a capital gain position, I have developed a flat fee service where I can work directly with your sellers. So you're not giving tax advice, but you may identify and go, ooh, I think you need to talk to an accountant because you're going to have capital gain on the sale of your home. We can work together. I can get them their projected tax liability. And what that does for you is, you know that they know how much to set aside from their net proceeds, so that you all know how much money is available to put down on the next purchase, for example. So when you run your estimated net sheet, I almost wish you could asterisk the bottom when it says net proceeds and say, this is potentially pre-tax, so consult a tax advisor. And on the other side are buyers. If you have buyers that you hear that may be selling all of their stock options to raise for down payment, those stock options have capital gains, and they also need to set funds aside. So same flat fee, you can make an introduction directly. And so I've been supporting a lot of your clients, both buyers and sellers, understand their capital gain position. And this, if you, any of us that are homeowners, this is information that's important for us too, if we sell and incur capital gain. So more questions. And in case you can't tell, sometimes I can't answer them specifically because I don't know your entire situation, and it probably is a little too, nuanced or personal to be live, but I can answer more questions on a high level. So let's see. Let me check the chat. I am not an attorney, so I do not develop or write or draft living trust, but I work with a ton. Annie works with a ton. I look at all of my clients' files, and I'm raising this question with all of my clients to have a living trust in place. And I will say, and I will explain here what I tell all my clients. If you're over 18, you should have a living trust. It's not just owning real property. It's not just having children. It sets medical directives and financial powers of attorney. So even in the case of a temporary incapacitation, so I saw this happen a couple of times during COVID, someone was in a coma. How do their bills get paid? If no one has a financial power of attorney and they're in a coma for an extended period of time and they're not able to stay on top of their finances. Or college age children. This was something that I witnessed personally in my family. 19-year-old is in a very bad car accident. That 19-year-old is of age. Parents are not able to have all of the information without a medical directive and a medical orders in place. So a living trust is something that we should all have, regardless of our life circumstances. Let's see, retirement. Let me read this question. Can you put money? You also need to put money into your employee's account. So if you have a SEP IRA and you have employees on W-2, so not 1099 contractors, but W-2 employees, your SEP IRA plan documents probably dictate some profit sharing throughout the entire company. So talk to your retirement plan administrator about that. That's not an area that I specialize in, but you do need to talk to your retirement plan administrator. Annie will have a copy of the slides, so I can share the slides. Anyone else want to unmute and jump in with questions?
Yes, thank you, Andrea. Just to underscore what you said, you can reach out to me, Annie Tyler, Fidelity Title. Kim has my information for the slides.
Perfect. No one else has any questions? Go ahead.
I have a question, Andrea. Thank you. Do you have any recommendations for a retirement planner, estate planner?
Oh yeah, you know what? Send myself and Annie an email. Some of our references may even overlap, but yes, we both have a lot of references. I typically, let me just say this with investment advisors. I typically refer to folks who are independent of a brick and mortar bank. What do I mean by that? I don't typically refer to someone within UBS or within Wells Fargo. I tend to use advisors that are independent of that because I think they can see bigger picture and they have more access to different funds, and estate attorneys as well.
And quick note, I put my email address and name and title in the chat for everyone if you want to grab that now, because I know we have about 5 minutes. It's 11:10, Andrea.
Thank you.
Hi, Andrea.
Hi.
I wanted to, I don't know if you were not able to catch my questions, but if it needs to be an offline discussion, that's totally fine. In regards to a home office, because it's within a home, I've been wondering, are costs to restore any damage 100% deductible?
Oh, only to the extent that they're not reimbursed by insurance.
Got
your net cost after insurance reimbursement is what's the deductible part. And then the deduction is limited to the square footage allocation, unless it was specifically your office space. But the repairs are also, you apply the square footage allocation.
Got it. So it's within, got it. So it's within the confines of what the apportioned is already. Then on top of that, what the insurance deductible that they paid, then the whatever amount above, but it's still totally acceptable, 100% deductible after that fact, right?
Yeah,
okay,
yeah.
great. Okay, I have a big gaping hole when I do Zoom calls, so thank you for this
You're
info.
welcome. Yeah, you're welcome. Anybody
And
else?
someone's
Jump in.
asking for your contact info, but I presume you have a slide for that, or
Oh, do I? Did I? Maybe I did. Oh, actually, I kind of took it off.
It's on the upper hand corner of one of your slides.
Oh, okay. Well, let me just drop it in the chat here. And then go ahead and jump in with any more questions. I'm sure someone has a question. What are some of the things I've been asked recently? Improvements. You know, this is as we talked about cars. Solar, two different things. Electric cars. The list was kind of restored and expanded of qualifying cars because and some manufacturers really have reached a phase out. But if you are in the market for a new car, check the list if that's something that's of interest to you. Going along with electric car, maybe solar. Electric generation, that credit was also restored back to 30%. So under Tax Cuts and Jobs Act, it was starting to diminish. And then during, I don't know, the last 2 or 3 years, they restored that back to a 30% solar credit. So that is, you know, if that's something that's on the radar, that does create a tax savings federally. Kids, that's something I didn't talk about. I just looked at a picture of mine. If you have minor children that are able to work for you, you can pay your minor children a wage. And by wage, I'm very specific here. It has to be a W-2, it's not a 1099. So you have to have a payroll service provider in place. These should be age appropriate and legitimate job responsibilities. So teens can be helping with IT, dropping flyers, setting up open house signs, you know, making phone calls, scheduling appointments. Younger kids like myself, my son receives a modeling fee because he's on some of my marketing materials. The benefit to that is that you're creating a deduction for money you were probably already giving the kids anyway, right? Whether it's allowance, whether it's tuition, sports. So this is allowed. You don't want to go above the annual standard deduction, which changes every year with inflation. I think it's 12,950 this year. Double check. I don't commit those to memory. If you have a teen with a summer job, you want to keep that in mind so you don't push their total wages over the standard deduction. But this is a real and legitimate opportunity because we're self-employed. And like I said, it does require some coordination. You have to have a payroll service provider. It has to be on a W-2, and it has to be for something legitimate that you can substantiate with job duties and a job description. age appropriately.
Okay, well, we just hit 11:15 and I think we hit all the questions in the chat. Thank you so much, Andrea. We appreciate you so much. Do you want to put your contact info in the chat real quick or?
Sure, it's
slide.
there. Oh, maybe I replied to someone directly. Let me put that in the chat. And I see one more question about retirement. Roth IRAs are different than SEP IRAs. There, you can do some reading about why it's great to have both. I would focus on a pre-tax, so a SEP IRA or a solo 401k first, but do some research. But they're not the same. There are not Roth SEP IRAs. So there's either a Roth IRA, which has a much lower limit. The reason I'm saying that you want to use your pre-tax retirement is the upper Roths are limited to 6,500. The upper limit of a traditional, I shouldn't say traditional, a SEP IRA or solo 401k can be upwards of 60. What was it for next year? 68,000. So it's how do I just copy and pasted something different. I'll put my website and my email address in the chat for everyone. Thank you for your patience while I struggled with the chat room and my dog barking.
Oh no, we appreciate you.
Oh, thank you. Thank you, everyone.
All right. Well, thank you so very much, Andrea. And I'll look forward to, like you said, forward those slides to me later on when you have a chance, and then I will forward them to any who have made a request.
Thank you, everyone. I'm going to log off. Bye.
Bye now.
Thank you.